How do you qualify for money for your business just because you have consistent cash flow? Well, that's exactly what we're going to talk about during today's training. Today, we're going to talk about how you can get money for your business, even if your credit's bad, and even if you have no collateral, no assets that can serve as collateral with as little as 6 months worth of consistent cash flow in your business. We're going to decode a lot of different ways that you can use cash flow to qualify for financing. We're going to talk about financing you can get in less than 72 hours. We're going to talk about how to get the most financing using these programs at the best terms. And if you stick around to the end, I'm going to get you access to our funding vault of 27 killer ways to get money to grow your business, including just, I don't know, some of the 8 or 10 options that we'll be talking about today as well. So a lot to cover. Let's talk about this. So there's 3 main ways to get money for your business. I oftentimes refer to this as the 3 C's cash acquisition formula, because I think it's just easy for business owners to be able to recognize what it takes to be able to get money for your business. Look, the confusing and hard part right now is that it used to be when we wanted money, we went to our banks. We went to big traditional banks. We went to Bank of America and Chase and Wells Fargo, and they offered us SBA loans. Then in 2008, mortgage crisis occurred. Dodd-Frank comes into play. Banks tightened up. There's a window of opportunity. All these alternative lenders hit the space. We now refer to them as online lenders, alternative lenders, fintech lenders. And here's the big win for us as entrepreneurs. SBA loans require good credit and collateral and, years of tax returns to verify cash flow. All the stuff that you just can't get, and unless you're a really well-established business, unless you've already overcome some of the biggest obstacles that business owners face to launch a successful business and get it to start to grow and scale. Then these alternative lenders hit the space and really simplify what's involved with getting money for the business. And what they're based on is this 3 C's cash acquisition formula. And how it works is you only need one of the C's to get money: cash flow, credit, or collateral. That means if you have one of the C's, you don't need the other 2. And today we're talking about cash flow lending. So we're talking about money you can get that's not based on the other C's. You don't need collateral and you don't need good credit to get it. So it's basically you getting money using the cash flow, the consistency of cash flow in the business as collateral to be able to qualify. Now, a lot of different terms. Qualifying is really based on the consistency of cash flow. A lot of them don't have minimum credit score requirements. Often you don't need to have years in business for many of these programs. You only need about 6 months worth of time in business as well. All they really typically require is you need about 6 months worth of bank statements to be reviewed in order to qualify. So what's needed there with a 6-month review of bank statements? Well, what they're typically looking for is a handful of different things. And by the way, if you're just coming in and if you're getting value from this, make sure you hit the like button just to give me a shout out. I can see those in real time. And if you don't mind, tell me where you're from. I appreciate that. I always like giving you a shout out and saying hello. So tell me where you're from. So when we look at what they're looking at in your bank account, there's usually a handful of things. They're looking for, first of all, consistent deposits. They don't want to see deposits in January, none in February. They also want to see a higher volume of deposits. They don't want to see 2 or 3 deposits in a month. They want to see, 10, 15 consistent deposits throughout the month, right? And if we think about why, it makes sense. First of all, they want to see consistency. If they're going to take the money out of your bank account to get them paid, as they do in many cases, we'll talk about today, they need to make sure the money's going to be there. So if we see a negative ending bank balance, if we see non-sufficient funds, those aren't indicators that the money's going to be there to pay back the loan. So they want to see those kind of indicators. So when you're thinking about bank account management here, you just want to think about what indicates that you are actually coming in. And excuse me, I just got my phone changed over here. So having a hard time turning off my ringer and all kinds of crazy stuff as I get my new phone set up. So that being said, we think about what is an indicator to the lender that you actually have the money to be able to pay them back. And we think about the fact that you have money at the end of each month in your bank account, okay? Positive ending bank balance. We see positive cash flow. More money going in the bank account than's coming out is definitely a factor as well. We look at factors like that you don't have non-sufficient funds, that you're not overdrawing the account, that you have a lot of consistent money coming in. Those are just indicators that the money's going to be there to pay back the lender, okay? So that's ultimately what the funder is actually looking for. Now, let's start with PayPal working capital. And there's a reason for this. I like PayPal because of two reasons. First of all, it's one of the easiest types of this kind of financing you can get. Cash flow financing, one of the easiest to qualify for. Well, three reasons. Secondly, it's some of the cheapest money you're going to get. In a lot of cases, loans like PayPal, Square, and Stripe don't even charge interest. They just charge you a set fee, not even interest. And the third thing that I really, really, really love about this kind of financing is that you can get nearly triple what you can with other kinds of cash flow financing. So with PayPal working capital, there's no personal guarantee. There's no personal credit check. So credit doesn't matter. Now, the loan amount you get depends on your sales that you're processing through PayPal. This is why I often instruct new business owners, get a business bank account set up a PayPal account, start processing part of your customers' payments through PayPal, or let your customers pay through PayPal, because it'll open up one of the easiest funding opportunities to get. Typically, they'll want you to have 6 months time in business, as much to a year, 6 to 12 months time in business. They'll typically, here's what I like, will lend you as much as 30%, 30% of whatever you're annually processing with PayPal. So if I process $100,000 with PayPal, I can usually get a $30,000 loan advance to them. Now, you've got to have a PayPal Premier account with them for 90 days or more, only 3 months to be able to get approved. You need to process 20,000 or more in annual sales with them to get approved, okay? Or 15,000 in annual PayPal sales if you have a business PayPal account but don't have a Premier account. And you've got to pay off any existing working capital loans that you really already have with PayPal. But if you do this, then if you have the volume of sales, there's a good chance you're going to be able to get approved. Now, they'll automatically deduct payments as a percentage of your PayPal sales. So oftentimes it's money you don't even notice is gone, and that's how they get paid back, okay? And again, the amount you pay back changes based on sales volume. Another reason I love this, if your PayPal volume tanks because it's January post-Christmas and you're selling stuff where your season is the holiday season, then your payment tanks, right? You don't have a high payment when you're not bringing in the high revenues. So it works with you. So if your revenues are down, your payment goes down. So it's much easier to manage than set loans. I have set loan amounts that you've got to be paid. Now, on days without sales, you make no payments, but they do have a minimum repayment required every 90 days. So you got to at least, like, you can't just get a PayPal loan and stop processing payments through PayPal. They do have a requirement that like every 90 days, a certain amount has to be processed through them. Now, you've got to pay 5% of the total loan amount every 90 days. That's that requirement that they have based on your past PayPal history or what you processed previous, right? And you've got to pay 10% every 90 days on loans estimated to be repaid back within 12 months. So again, works with you, flexible, your sales go down, so do your actual payments that you got to make to PayPal. And this is really minimum. 5 or 10% or 5% of the total loan amount's got to be paid every 90 days. That's really simple, especially if you're paying it back over 12 months. So again, getting value from this. Tell me where you're from. Tampa, Florida. I got a Facebook user, doesn't say your name in here, from Tampa. So thanks for giving me a shout out and saying hello. And Winston says, MCA, we will talk about merchant cash advance loans today as well. So really love PayPal. Again, oftentimes get approved with no interest, as fee as low as $500. They also bought a company called Swift Capital. So they offer normal cash flow financing as well. Even if you don't process through PayPal, they do have options for you as well. We'll talk about that when we get to cash flow financing. No credit check, no personal guarantee, up to 30% of what you process with them annually, minimum money that's got to be paid back to them. Just a great opportunity. One of the easiest I found to be able to get money to grow your business. Now we're going to talk about Square. So when we talk about Square is just kind of similar to PayPal, right? It's a platform you can use to process customers' payments. Now, applying is not going to affect your consumer credit score, and eligibility is based on factors including the volume of money that you process with Square. Now, you can typically get up to $250,000 based on what you're actually processing with them. And again, PayPal, Square, and Stripe all go about as high as 30% of what they'll lend you is what you're processing with them. No interest, just a flat fee. So really cheap money to be able to get as well. You've got to repay an eighth of the initial balance every 60 days back to them. No collateral at all is needed for loans of $75,000 or less, but they may require collateral if you're borrowing more than $75,000 with them. And just be aware they'll file a UCC filing with the Secretary of State. So what does that mean? A UCC filing is just simply a way of a lender telling other lenders that you have an outstanding loan. So a lot of places like Square won't report the loan on your business credit reports. So they've got to have a way of telling other lenders, hey, this person owes us money. Keep that in mind if you're lending them money as well. And that's what a UCC filing is. It's filed to tell them you have outstanding loan with Square. And then when the loan is paid off, they remove the UCC filing. That's actually how that works. So it's not a negative. It's just a way of them actually letting other lenders know that you have an outstanding loan. Now, outside of PayPal Square, you also want to look at Stripe. Stripe is very similar to everything I've talked about with these two. And PayPal, Square, and Stripe, if you process money through any of those three sources, some of the easiest to get money, credit's not a factor, low fees, really not interest that they're charging you, easy to qualify, fast to get, and really high loan amounts, 30% of what you process with them. Now that brings us to business revenue lending, or what's called cash flow financing. And with cash flow financing, basically what you're doing is you're basically selling a portion of your future revenues to a lender for a discount. It's not really a loan. It's literally selling future revenue to a lender for a discount. That's ultimately what revenue lending is. It's also called cash flow financing. And you can oftentimes get about 15% of whatever you process annually in this kind of money. Man, this is everywhere. On deck, there's these lenders all over the place. You used to, there before COVID, see ads all the time in Facebook of, hey, if you've owned a business over a year and have $10,000 a month in revenue, you can qualify for business revenue lending. And business revenue lending, they look at all the money going into your bank account, checks, cash deposits. They look at all that, and they'll usually lend you as much as 15% of annually whatever you have going in there. Again, 6 months bank statement review. I already told you what the lenders are looking for. Very similar as well to what are called merchant cash advances, but merchant cash advances are a little bit different. Revenue lending looks at all the revenue in the bank account, cash, credit, and checks, right? Merchant cash advances only looks at credit card transactions, mainly Visa card and MasterCard. So not as much of your revenues taken into consideration for a merchant cash advance, but the difference is that a merchant cash advance you can easily get with 6 months time in business and $5,000 a month in minimum revenue. So if you got $5,000 a month in revenue, 6 months in business, merchant cash advance can work for you perfectly. Most cash flow financing lenders want you to have $10,000 a month in revenue or 1 year time in business. You just see more revenue, more time in business for cash flow financing. So some things to keep in mind between the two, okay? Loans are as high as $500,000. Interest rates on these things can be cheap or very expensive. And by cheap, I mean the cheapest I have personally gotten myself is 8%. And these things give people a bad name, meaning that a lot of people give a bad name to cash flow financing or merchant cash advances because the interest rates are so high. Sometimes they're 30, 40, 50%. Now, I'll tell you a little secret. I spent my life in financing, and I love high interest rates. I love them. And here's why. High interest rates mean high risk. So what that means to me is if I see a higher interest rate, it means I have a lender that's willing to lend to a very high-risk person. And that high-risk person 7 years ago, 10 years ago, would have never got a business loan. Nowadays, there are solutions for that person, but they're going to pay higher interest because the risk is higher. Now, things that affect your risk include your credit score, right? You could still get approved regardless of personal credit quality, but the better your score, the better rate you're going to get. The longer the time you've been in business, the better you manage your bank account. As I talked about in the beginning of this training, here's how to manage your bank account to have the best chance of getting approved. So these are factors that affect your risk. So I oftentimes say, look, if you don't like the risk, or if you don't like the interest rate, then lower the risk. Meaning, never be upset that a lender's giving you a high interest rate, then control the factors that's making your risk high. Set up your business where you're fundable. Address your personal credit issues. Manage your bank account responsibly. These kind of things will lower the interest rate and lower the risk. Now, let me tell you why I don't care about interest. I'm going to give you a perfect example. We had a client, the highest amount of interest I've ever seen paid. He paid 65% interest on the money he borrowed. 65%. I don't think there's any one of us that won't say that we think 65% interest rate's a high interest rate. I think we all agree that's pretty high, right? So, but here's the real story behind this guy. The guy was de-stumping golf courses. He was building golf courses, right? And I didn't know this existed, but what he was wanting to buy was a piece of equipment that de-stumped the golf course, right? So instead of manually people going and digging with backhoes and stuff and all the stuff that's needed to like dig a stump out of the ground, I don't know what that is, but you can think about backhoes and all the stuff that's involved, the people and all the manpower. He had a machine and he wanted to buy a machine that de-stumped it. So he paid 65% interest. We're all like, that's absurd. But let's really look at this. First of all, 100% of the interest is tax deductible. Doesn't really matter. He gets all that money back anyways. And he saved $10,000 a month buying this machine at 65% interest, then manually paying the labor he was paying without it. So did it make sense to him? He pays interest that he gets 100% back of as a write-off, and then he saves 10 grand a month. It makes perfect sense. You never want to evaluate funding based on the interest rate because you can write off the interest, and the interest is based on risk. You don't like the rate, then lower the risk. But you want to judge it based on the make sense of the actual money you're getting. So let me give you another example. A teacher of mine, Mark, okay, good friend of mine, and we were very close when I was in high school as well. Okay, he has a business that's a seasonal business, right? His business dips down in the winter and then it increases in the summer. But he came to me and said, what about this kind of money? I said, never get this kind of money. This kind of money is not for seasonal businesses. It's if you're going to get the money and invest into something that's going to give you a rate of return. I'll give you more about that in a minute. Then he went to somebody else. Person gave him a really high interest rate as I knew they would. And I see him on social media slamming that person saying, how dare can somebody charge me this much interest? It doesn't solve my problem. No, this is not the kind of money. Merchant cash advances, revenue lending. This is not the kind of money you get to fix seasonality problems. This is the kind of money you invest into something that's going to get you a rate of return to increase your revenue to pay for the debt you're getting. Let me give you an example. First one of these we ever got was a $75,000 loan. We used it to open an office, to expand our sales team, and to be able to do three things, including turn on 2 new lead sources that were going to give us leads. We used the money to make moves that would bring more revenue into the company. More revenue came into the company, and quickly we made way more in additional revenue and profit than the money was costing us. That's what you're looking for here. Now, PayPal, Square, Stripe, that kind of money is very affordable. You can get that money for anything and use it for any purpose. Revenue lending, merchant cash advances. It's short term, 6 months to 5 years typically. The interest is higher. So when we see these combination of shorter term, higher interest, we never want to use that money for anything other than I'm going to invest in something that's going to get me a rate of return. Hey, Ty, I dumped $500 on Facebook ads and I earned back $3,000. Now I want to scale my Facebook ads because I know the more I spend, the more I'll make, but I need money to do so. That's an example of where this makes sense. You're going to take the money and immediately invest it into something that's going to get you a return way more than what you paid. That's what we look at. When we look at higher interest rates, shorter term, like revenue lending, merchant cash advances, that's exactly what we want to look at it for, is for investing into something that's going to get us a rate of return. Now, as I said, merchant cash advances, 6 months time in business, $5 grand a month in revenue. This kind of money, usually 1 year time in business, $10,000 a month in revenue. Now, brings up one other point. By the way, if you're getting value from this, hit the like button, hit the love button, and also make sure that you tell me where you're from. I always like saying hi to everybody. A lot of people coming in. Minnesota's in the house. Florida's in the house. Sioux Falls, South Dakota's in the house. What's up, Steve? Thanks for coming in. And Stump Grinder. I love it. Buffett knows. Buffett Slayer is like, Stump Grinder. I know what that thing is. Okay, Steve Rivas says, I built a miniature golf course in 1977 fresh out of high school. That sounds awesome, man. I'd love to do that. Sam from Jacksonville, Florida is coming in. And Teresa says, I live in Deer Park, Texas. My Facebook page is Teresa's Helping Hands Services. And I also pay Nextdoor site for for my neighborhood as well. And Steve says debt leverage is all about creating positive cash flow. Okay, so I love what Steve just said here. I'm going to pull this up. Steve says debt leverage is all about creating positive cash flow. And what he's saying is spot on. You want to borrow other people's money, OPM, and use debt to come in and create more cash flow for the business to increase the cash flow and profits. And if you could do that, then oftentimes what happens is it makes sense to get the money even if you're paying a higher interest rate than what we'd all like to pay. Now, this brings me to qualifying to compensating factors. Spending my life in financial services, I can tell you that whenever there's a rule, 1 year in business, $10,000 a month of revenue, there are always compensating factors. If you're in a low-risk industry, if your credit score is good, if your cash flow management's solid, if you got a bunch of money in the bank, there's all these factors, longer time in business. These can be compensating factors that can help you get over these requirements, but these are the typical requirements for revenue lending and merchant cash advance that we talked about here. Now, AR financing, I don't know if it should be here or not. It's not really cash flow kind of financing. I put it more of an asset-based kind of financing. But I'm bringing it up because, again, if your customers are paying you and you let them pay you on terms, so instead of them giving you, and I'll give you an example. If you enroll with Credit Suite to build business credit, improve your fundability, and get financing, we've got a great package called the Business Finance Suite. It's our core package. It's $3,000. You could break it up into payments of $600, for example. If you buy from us and you take those $600 payments, that is what's called AR. It's account receivables. We're letting you finance your enrollment on terms, and that becomes an asset to us that we can use to qualify for SBA loans. It's also an asset that we can actually get financing on. So we can actually come in and take all of our AR, go to a lender, instead of waiting 7 months for our customers to pay us. AR financing lender pays us the majority of the money, 80 or 90% of the payment right away, the next day, instead of waiting 7 months. So it's easy for us to let our customers pay us over time. We get the majority of the money right away. The lender collects from the customer, taking a weight off us to begin with. And in doing so, it makes it easier for us to be able to come in, let our customers payment on terms. We still get the majority of our money right away. Everybody wins. Let me give you another example of this. We have a lender called Nove. I love Nove Financial. Nove helps finance a lot of our customers. So our payments might be $600 a month to enroll with us. Nove will take our customers with even average credit. They will offer the customer financing. They will finance our enrollment. And then what will happen is the customer can pay less than $100 a month to work with us instead of $600 a month. That's what AR financing, an example of what can happen. That Nove pays us right away, right? So they pay us right away. They collect if the customer defaults, whatever it may be. And we get our money right away. The customer gets less than $100 payment, something they can afford, and everybody wins. These are simple examples of AR financing, another creative way that you can tap in and get money for your business. As much as 90% of the receivables can be paid to you in as little as 24 hours. Really low factor rates, less than 1.5% typically. And they can do this kind of financing up to $10 million if you have that much in AR to do. 1 year time in business, some sources, other sources have no time in business requirements as well. And I also want to talk about a couple other options here as well. Hakeem says Oakland's in the house. Travis is coming in from Minnesota. We've got Mississippi in the house. We've got Wade from St. Louis talking about it, saying hello. Steve's chiming in, talking about what we just mentioned, factoring. Okay, and Samuel Jean says, when are you having a live event? The first quarter of next year. We're going to have our first ever live event, and it's going to be specifically for those people that want to become business loan brokers or already are. So if you're interested in offering business credit and financing as a service, I've got a challenge coming up next month that will help you do that. If you haven't, get on our email list. Go to this link right here. Well, no, not that link. Right here. creditsuite.com/live-27. The link at the bottom of my slides. That will give you a great guide on 27 ways to get money for your business. It will put you on our email list. And then next month, March 21st through the 25th, we have a challenge for people wanting to become business loan brokers. And we will also be doing our first event to help people excel as business loan brokers in the space of offering business credit and financing. And that will be the first quarter of next year. Great question. I appreciate that. Buffett says, hey, is this the same type of deal that Steve was doing Tuesday? No. Tuesday, Steve was just doing a webinar. That's just a normal webinar that we typically do. The only difference is I was at a mastermind Tuesday and Wednesday, so I wasn't here to do them, so Steve did them in my place. So that's just a regular webinar is all we did last Tuesday or this Tuesday, but the challenge will be something unlike anything that you've seen before. I think you can go to businessloanbrokerchallenge.com. I'm not even sure if it's up yet. So before I even say that, let me see. I don't even think we've opened registrations yet. Business Loan Broker Challenge. Let me see here. Challenge. Oops. Typing problems today. But again, if you're on our email list, we will let you know. We do not have that open yet, but we will be opening enrollment, and you'll hear about that soon. And no, it is not the same as what Steve did yesterday. This challenge will be a 5-day interactive event where we'll bring in a lot of different speakers that will teach you. All the gurus in the business loan broker space will be there. We'll have lenders there teaching you how and helping you get signed up with them as lenders, how to set up your business, how to structure it, how to grow the business, how to advertise, how to market, everything on how to break into the business loan broker space and excel. That's what we'll be covering March 21st. Get on our email list. And again, here's the link to do so and grab a free guide with 27 ways to get financing. I'll also be promoting it in my live streams on our social channels, all of that as we get closer. So other options based on cash flow here. Bluevine and Fundbox, two of my favorites. These are credit lines based on cash flow. And they use AI, artificial intelligence. So what that means is it means you can typically get an underwritten and funded same day. It's very fast money because the underwriting is done digitally. It's not you supplying all this documentation in order to do it. So Fundbox is one of the best out there. 6 months time in business. If you go to creditsuite.com/Fundbox, you can get approved. And again, how much you get depends on how much you're running through your bank account. And if you get approved, it's based on how you manage your cash flow. They will do a credit check, but it's not based on personal credit quality. Okay, so I love Fundbox. Bluevine also goes up to 150 grand. Harder to qualify for. 620, 630 FICO score. A little bit more money you'll get. A little bit better terms. But again, the problem with them is that it's harder to qualify. So Fundbox will want all their money paid back within 6 months. Bluevine gives you a year. So better terms with Bluevine, but harder to qualify. But if you want a credit line based on cash flow, Fundbox and Bluevine are very good. Other cash flow financing lenders like On Deck are also very good. So an On Deck of the world can also lend you money in a loan or a credit line based on consistent cash flow. And then we talked about merchant cash advances as well. So those are some more options where you can get funding based on cash flow. So to recap, look, 3 ways to get money: based on your collateral, based on your credit, or based on consistent cash flow. Today, we talked about getting money based on cash flow. We talked about PayPal, Square, and Stripe. Great sources to be able to get money. 30% of what you process annually. Really, a lot of them don't charge interest. It's just a set fee. If you're processing customers' payments through PayPal and Square and Stripe, good options. Merchant cash advances, cash flow financing, revenue lending, all money based on you having consistent revenue. Your credit really doesn't matter. Your collateral doesn't really matter. Low interest rate as low as 8%. High interest rates as high as 35% or more, depending on risk. But again, really good to use these programs to invest in something that's going to get you a rate of return. Okay, AR factoring, not really a cash flow kind of financing kind of product, but I threw it in there because if you got cash flow, then that means your customers are paying you on terms. It's something you should consider there as well. And we've talked about credit lines, Bluevine. We've talked about Fundbox. We've talked about On Deck. All credit lines you can get just because you're consistently bringing in cash flow and managing your bank account responsibly. Some really good options that could work for you as well. Now, Steve says, would you call these hard money lenders? I think it's a great question, Steve. And the reality is that I personally don't, but it's not to say you should or shouldn't. I think, for example, if I'm flipping houses, if I'm doing house flipping and I have no experience in house flipping, I can get a house flipper loan for 100% of the money I need to buy the house and rehab the house. And my interest rate could be 8 or 9%. That is considered hard money. To me, that's absurd. 8 or 9% is not a hard money loan. So I think that's a subjective question because there's no solid definition of exactly what that is defined as. But hard money lending to me more comes from private investors that are doing deals at double-digit interest rates. When I look at hard money, I'm looking at private investors, not any kind of funding institution or lender that's actually lending money and being able to do it at double-digit returns. That's what I classify it as. But I just gave you an example of a house for seller, which others consider to be hard money, even when I think it's absurd. I don't think that's hard money lending at all. So some things to keep in mind. And if you want to get approved for Fundbox, here's that approval link. So next time we're going to cover how personal financing can impact business lending, what you can do about it, and how to use it to your advantage. Because again, that's the problem. If you're using your personal credit to qualify for things, you need to know how personal financing is going to impact business lending and how it impacts your ability to get money from the business for your business. So those are some of the things that we're going to talk about next week. If you're interested in getting money for your business, give us a call. We don't charge you a dime, no money to get loans and credit lines. We will help you determine what kind of funding you can get, help place you with the funding source. The lending source charges interest rates and fees. Of course, we don't. We don't charge you money on the front end or back end. It costs you less money to work with us and go to the lender direct because we do so much volume with them. They give us discounts that we pass on to you. And our goal is to help you get all the money you can get now and eventually graduate up to SBA loans. So if you just want somebody in your corner that's here to help you get money, that's exactly what we do. Reach out to us and let us know. 877-600-2487. We'll also give you a free funding assessment. And the funding assessment will determine all the money you're able to get right now. We will also come in and do a fundability check to make sure that all your fundability is in line, give you tips there to improve to get the most money. We'll even help you get your business credit reports for free, go through those with you, give you tips and tactics to build your business credit. So it all happens on an absolute free financing assessment. All you have to do is give us a call for that, 877-600-2487, or schedule online at creditsuite.com/consult. And if you got value here, like and subscribe. It's simple. Just hit the like button right now. Hit the subscribe button. By hitting like, you're telling the social channels this was valuable. And then they show it to more entrepreneurs. And together we can help more people. And that's my goal. I'm not here pitching anything or selling anything. I'm here 100% to give freely in the intention of helping you and helping others. So if you can help me help others, I would appreciate that. Just like and subscribe. And don't forget, we have daily tips on Facebook, Twitter, and on Instagram. We are Facebook, Twitter, and Instagram. We also have 1-minute videos on Insta, 1-minute videos on TikTok. We've got 1,000+ videos on YouTube, a podcast you can listen to on the go with 500,000 downloads. All of that is on the top right of our page, creditsuite.com. Go to creditsuite.com right now. Look at our channels. Click subscribe. Takes less than a minute to subscribe, and you'll be notified. And all of our information is all about one thing: helping you get the most money at the best terms for your business. So if that's what you want to do, then go to those channels. Make sure you like and subscribe. Okay, and JMS says, that's what I'm looking for. Awesome. So JMS, if we can help you in any way, give us a call. We'll talk to you a little bit more. It's 100% free to get that funding assessment. And Steve says, excellent as always. Man, Steve, I love the fact that you're always here, man. It always means a lot. Thank you very much for tuning in. So I'm going to go ahead and wrap up. Look forward to talking to you next week where we're talking about personal finances and how it affects your ability to get money. If we can help you in the interim, give us a call. Right here's our information for your free funding assessment. It's 877-600-2487. That's 877-600-2487. Thanks for tuning in. Have a great day. I look forward to seeing you next time where we talk about getting more cool ways to get money to start and grow your business. Take